Hello, and welcome to our webinar on costs and benefits of a customer-focused future. Thank you for taking some time out of your day to go through with us the results of the project that we did for Renew a little while ago. The topics we're going to cover today is first the project drivers and key objectives, our modeling methodology and the scenario settings, and then the cost-benefit assessment results, followed by a question and answer section. We're going to mainly focus on questions at that stage, and we'll be moving through the material at pace so that we have time at the end. If you have any questions along the way, I recommend that you put it into the chat and it will be flagged for the Q&A period. Thank you very much. So I'm going to hand over at this stage to Dean of Renew, who was our client for this project, to give us some background as to why he commissioned this work and his thoughts on its results and implications. Dean, please.
Thanks, Ezra, and thanks everyone for coming. So I was going to give you a couple of minutes background why we did this project and what we're sort of looking for from it. Basically, this project started for us because in talking with clients and members of Renew, which is a community-based member organisation that focuses on helping people live more sustainably. And we also do sort of consulting and energy advice. And in talking with people that we do that advice with and with our members, we became concerned several years ago around the way that networks are using export limiting or zero export limits in particular, and capacity limits for solar systems. People would often be partway through installing a solar system and then find out that they were going to be limited to a low or zero level of exports, and they didn't really understand why, and the information wasn't out there. It seemed to us that it seemed clear that this was an approach networks were taking to manage problems, but it seemed to us that the approach was sometimes a bit arbitrary. For example, one network just counted the number of solar connections on a feeder, and once they hit a certain number, they just didn't allow any more. That seemed arbitrary to us. We wanted to dig down into the detail, find out what are the technical problems and what are the different ways of dealing with them. So we proposed a project to Energy Consumers Australia, who funded us, and we basically contracted with Energeia to work with us on the project, do the analysis. And that stage one project back in 2019 was really focused on understanding what are the technical issues, what are the ways of managing it. So we basically documented, we consulted really widely with, especially with networks and other stakeholders. We documented a whole lot of technical problems that could be caused or exacerbated by, or even just sort of surfaced by solar connections. We also sort of canvassed all the different ways of dealing with those problems, and we documented this all in our first report, which at the time was really the only place that it had all been documented together. A number of people sort of told us that, yeah, none of this was a surprise to everybody, but it hadn't really been put in one place before. And one thing we did as part of that project was also to get some estimates on the cost of the interventions that would deal with the issues. And obviously, cost varies enormously because of numerous factors. But we basically got some sort of ballpark figures for sort of typical costs, and that was the first project basically. One thing we realized from the first project was we really need to step back and look at the bigger picture, especially if we're trying to do what I guess Renew's main aim was, which was to basically turn the system around from being sort of network perspective to consumer perspective. How can we help people give people the maximum choice in installing DER in a way that still keeps the system sort of reliable and secure? We realized we needed to take a bigger picture of the whole system impacts and the whole system potential, I guess. So we again got some funding from Energy Consumers Australia for a follow-up project. This was in 2020, to basically do that. And that's what this project is that we're talking about today. What we were really trying to do with this was, I guess, sort of almost look at a utopian future. What is the optimum level of DER in the network, in the grid, basically, as a whole, that gives consumers the most choice, but that is also cost effective? What's the most cost effective way to reach an optimal level of DER in the system? And what are the barriers to getting there from here? And in our sort of utopian looking forward, it was a bit like, imagine there are no regulatory or market barriers. Imagine it's all just what are the technical possibilities, and then we work back from there to work out, okay, Now, what are the barriers to achieving them? And a lot of them are about policies or markets or regulation. And therefore, our hope was to get a bit of an insight into, okay, what are the policy changes, the regulatory changes, the market transitions that we need to prioritise for consumer advocacy in order to get to a future where consumers have the biggest opportunity to have DER in a way that's cost effective for all consumers and maintains a secure, sort of stable network. And, a big driver for all of this is that, we know there's heaps of people in the industry working on this issue. But in the end, that's an industry perspective, and of course it's an industry perspective. It's industry. We wanted to bring a consumer perspective to it. There's just not enough of a consumer perspective in these more sort of technical areas of the energy system. And we were really trying to change that, because Renew's always been about sort of bringing the technical to the consumer and household level and sort of marrying them together and opening up opportunities for consumers based on taking a consumer perspective into the energy system. So that's my little spiel. That's why we did this project. We're really happy with how it's gone, and I'll throw back to Ezra to take us through what the findings and the implications from the work that they've done.
Thank you, Dean. So the next slide just summarizes the national electricity objective. And the reason we wanted to just put this up front was the role that this plays in industry governance. And basically, if a potential rule change or a change to industry arrangements is inconsistent with the NEO, nothing happens. And it was therefore critical that the work we did to identify what the optimal level of distributed energy resources might be in a consumer-focused future was to bear this edict in mind. And the NEO itself is there to promote the efficient investment in and efficient operation and use of electricity for the long-term interests of consumers, with respect to, i.e., holding constant price, quality, safety, reliability, security of supply of electricity, and the reliability, safety, and security of the national electricity system. Now, we've highlighted efficient here, right? And efficiency generally has three common definitions. There's allocative efficiency, which occurs when the price of goods and services is set equal to their marginal cost. And this is why cost-reflective pricing is so important to the efficient operation of the energy system. There's also productive efficiency, where occurs when goods and services are produced at the lowest possible cost. And the reason this is relevant to this piece of work is that there are a number of different ways you can deliver an electricity service to an end user or consumer. And it involves it can involve different combinations of utility scale generation, different kinds of generation, but also different mixes of utility scale and behind the meter. And ultimately, to get productive efficiency, it's critical that the least cost combination of those range of services are implemented into the system over time. And that actually brings us to dynamic efficiency, which is to ensure that any sorts of innovation or changes in cost factors or factors of production is factored into the economic system over time. And so therefore, in order to demonstrate that one particular outcome is more efficient than another particular outcome, holding all of the attributes or outputs constant, like the same quality, safety, and reliability and security of supply, you must demonstrate that you are able to deliver those same outputs at lower cost, and that is the case over time. And so that's what we set out to do with our whole of system modeling. So ultimately, and this is illustrative, I need to highlight, that a customer or consumer pays a certain amount per annum, and this might be a typical retail electricity consumer. Now, a portion of that is due to a range of industry supply costs, including the cost of reliability and safety, often for replacing aged assets, the cost of thermal overloads. And those thermal overloads are not only due to increasing peak demand, but in the future, they're likely to be due to increasing exports as well. Voltage management, or addressing of voltage excursions. And this is just in the network portion. In the generation portion, there's the cost of the dispatch, i.e. fuel costs. And then there's the costs of procurement of, for example, the retailer obligation or any of the other ancillary services categories here. And any of those that are not forward-looking and based on long-run marginal costs, there's going to be some residual costs to be recovered, which are really just a reflection of the sunk costs that are recovered by regulated elements of the supply chain. So in order to model a least cost consumer-focused future, we have to try and address as much of these potential cost factors as possible. So in the cost benefit assessment that we put together for this project, we had generator costs and benefits, we had transmission and distribution or network costs and benefits, and we had retailer or DER aggregator costs and benefits, as well as consumer costs and benefits. And again, to reemphasize that if you want to do a reasonable assessment of whether one particular approach is more efficient, i.e. lower cost than another approach, you can't just look at the NEM costs, you can't look at generation costs, you have to also include the cost of the consumer. And so that's what our three main models do. So we've got WSIM, or Wholesale Market Simulator, which is a combination of a security-constrained economic dispatch engine combined with a capacity expansion capability. And that tells us things like generator revenues and also their costs, but also the amount of and the type of new generation that enters the system. And I'll get onto the specifics in the next slide. USIM really covers, which is short for Utility Simulator, customer behavior behind the meter and throughout the distribution network all the way up to the bulk supply point. So these two systems work together to give us a whole of system modeling capability. And then DSIM, or distribution system, looks in detail at the low voltage system, which is where most of the DER integration challenges have first been started to emerge. Now, based on the modeling outcomes, it drives changes in generator costs or benefits, network costs or benefits, retailer or aggregator costs and benefits, and consumer costs and benefits. And that ultimately is what feeds into our final cost benefit assessment. Now, in terms of a particular diagram of our whole of system modeling, this is what we use to try and communicate that. Now, we do a bottom-up model, also known as an agent-based simulation, and it is calibrated to each DNSP, or distribution network service provider, in the NEM by looking at zone sub data, which is publicly available. And we use agents or sample points to model customer behavior. And based on their historical adoption of behind the meter technology, as well as electric vehicles and appliances themselves, and whether they're gas or electric, that operates on an annual basis, given tariffs and given both electricity and gas tariffs, given technology costs. When we're modeling microgrids that'll take into account SAIDI and value of customer reliability, as well as underlying changes in energy consumption due to factors like changes in wealth, as well as changes in load factor. And generally, we will take the trends that are part of distribution network regulatory proposals. Now, based on all of these factors, each one of these agents adopts new technology or they don't, and then their loads are combined in a statistically robust way so that we can generate the impacts of those decisions on each of the assets of the distribution business, whether it's the zone sub. When we have the data, we also can apply it to HV feeders and LV substations. In this case, the only public domain information available at this stage really is the zone sub. So we use that as a proxy for the network. Based on the changes in the load profile, that can either trigger an additional investment, and that may be due to thermal overload or a voltage excursion. And at the same time, the distributed energy resources are tested to see if they can provide relief to that constraint at lower cost. And this is where the importance of doing that DER integrated distribution planning is so important, because it's here that you can really affect the productive efficiency test, whereas over here the consumers are really testing the allocative efficiency. But in both cases, whether the networks are doing it at the distribution planner level or the consumers are doing it, those economic processes are being modeled. Now, two other important modeling mechanisms that we employ are if somebody buys solar and they forego, they consume less and they pay less in their charges, particularly network charges that are regulated, that money has to be recovered the next year. So this is a closed loop system, and it takes account of what changes in consumer DER adoption due to network revenues and the importance of cost reflective pricing to try and avoid cross subsidies, and also having these uneconomic bypass decisions flow through into the rest of the system. Now, the combined load profile for each state is then fed into our wholesale market model, or WSIM, which takes into account renewable energy targets, carbon prices where they are there in the scenarios. There were none in these scenarios, generator bids, technology fuel costs, and existing generator attributes, and then the cost of new generators. And that all gets fed into half-hourly prices over the period to 2050. And that, both combined with the network price impacts, is fed back into the retail price impacts, and then it loops for every year. Now, we set this up for the scenario from the AMO ISP. We use the step change scenario, not the one that was just released in draft, but the previous one. But then we had to craft another scenario which focused on this customer focused future. So, and I just want to reemphasize that these are AMO's own sort of characterization of 4 of their scenarios. They also had a high DER, but I think it was somewhere over here. And to just highlight, you know, on the axes of decentralization and decarbonization, we really tested the edges of both decarbonization and decentralization in our so-called consumer high DER scenario. And this was really to sort of break through the current thinking that's been out there around, you know, what the envelope really is. And I think AMO's acknowledgement this year in its draft ISP that the step change scenario is now the planning or the midpoint scenario really is reflective of how much the envelope has shifted. And were we to update this, I think they being AMO have moved closer probably to the high potential here of high DER. So just to highlight on the right here some of the ways that the two scenarios different. Solar PV and storage prices. We used AMO step change for the AMO scenario. For the consumer high DER, we actually did a line fit and trended that out, and these are much lower than those that are assumed in AMO's scenarios. And something I should just highlight is some of the differences in the cost between the two scenarios is driven by things like having lower DER costs here. But I think that the issue that this raises is whether or not the trend is more appropriate, or the assumptions that were adopted in the ISP. In terms of the adoption rates, these are given here for the step change scenario, and you can see that the adoption rates in the consumer high DER scenario are significantly higher, up to 90% by 2040, and 90% for solar PV for 2030. So this is a very aggressive distributed energy resource scenario. For the sizes, and this was based on the step change, we actually calculated economically optimal here. And perhaps surprisingly to a lot of folks, if you read the report, we actually show economically optimal to be lower than what's currently being adopted in the system at the moment. And the reason for that is primarily due to the impact of additional behind-the-meter generation on curtailment. And until more coal and inflexible units exit the system, it keeps down in our modeling of economically optimal the size of the DER that's adopted. So we have more adoption, but for the most part, for the next 10 years, it's actually smaller than in the other than the step change scenario. And I encourage everybody to have a look at the differences. With the change in the retirements and the acceleration of some of the coal exits, we really need to have another look at this. And I would expect the sizing to increase as the retirements accelerate. In terms of electrification, this is a key assumption because the more electricity that's used by a household, the larger the PV system size needed to offset that consumption, and often the greater the peak demand as well. But we didn't want that to be a key difference between the two scenarios, so we had to make some assumptions here. For the buildings for transport, we kept AMO step change. Now for DER management, this assumes that 100% of the capacity is available for virtual power plant optimization between consumer benefits, grid benefits, and wholesale benefits. And that may be an over-exaggeration, but again, we wanted to see what the potential was here without having them vary between the two scenarios. And then finally, prices for fuel and utility scale technology costs were the same between the two scenarios. Finally, and this is another really key assumption, and really between the network LRMC and DER prices, that's a subject of possibly another future webinar, just because of how important those two assumptions are when considering what an optimal future energy system might look like. Here we use the published examples under the MO step change. For the consumer high DER, we did our own estimates looking at each of the DNSP's calculation of LRMC and taking into account the NEO and also the rules. Okay, so there's a lot more that could be discussed in the webinar on this particular project. It was a terrific project. It really helped us push the boundaries of our own modeling system. We introduced virtual power plant optimization that sat between the USIM modeling of behind the meter and the wholesale power market that allowed for the shaping of distributed energy resources to maximize their benefits in the wholesale market, and also allowed the value of that to feed back into the actual net benefits of DER investment. And ultimately, this is where we landed. We modeled it over a 30-year period, very long term, but we also wanted to look at a 15-year period as being nearer term and something that's more, I guess, actionable and more real than the next 15 years after that. And what we found between the two scenarios now, natural gas and petrol impacts there's no difference there, and that's largely, at least from behind the meter, because of the electrification scenarios being the same. Had we different electrification scenarios, these would vary between the two scenarios. Solar PV also doesn't vary much, which may be surprising, but even though one scenario has a lot higher adoption rates, the actual size of the adoption and the timing of the adoption make it so that there is not a material variation between the two scenarios. And I should be very clear here that the way we calculate this is by taking the AMO step change as the middle scenario. So we guess we got that right. And then comparing the relative costs of these categories of costs using the consumer high DER scenario. So if the consumer high DER scenario is a higher behind the meter storage cost, as it does here, that's $2 billion more in net present value over 15 years. Whereas the network capex, because there's a lot more substitution of behind the meter storage for augmentation in particular, but also some replacement investment, that the consumer-focused future shows a much lower cost. Network OPEX, there's not a lot of difference, but then in network, the NEM costs, we see $15 billion in net present value. And this is the largest category, largely from reductions in fuel burn, but also from a reduced investment in utility scale generation. There's also a lower CO2 cost, so that has a lower emissions, even though this may or may not be a real number. And altogether, that adds up to about a $25 billion savings of the high DER scenario compared to the ISP step change. Now, these are not forecasts, right? These are two different scenarios, and comparing the two scenarios gives us what achieving the consumer high DER scenario would save according to the modeling relative to the step change. And the thinking is, to the extent we're able to unlock or remove the barriers that the report identified, to achieving this sort of an outcome, and that the DER prices indeed follow the current trajectory and not AMO's ISP scenarios, then this is the outcome that we would expect to have. And the sort of, I guess, economic stimulus for policymakers, regulators, and industry to strive for a future like this, where consumers are paid $25 billion or charged $25 billion less, all things being equal, than under the step change scenario in the ISP. On a 30-year basis, the savings are slightly higher in present value terms, up to $69 billion. All right, I realize that we're almost, for those of you who have to get away, I want to at least have a couple of Q&A opportunities, and we'll continue to do the Q&A until, we'll see how we go for time on that, but we're happy to stick around to answer people's questions.
Ezra, if you look at the chat box, we have 5 questions from our attendees.
Okay, this is going to be interesting. Let me stop sharing. All right, so let's go with the first question. Are consumer investment costs behind the meter solar included in the costs? Yes, they are. That's a really important factor, especially when something like 25% or more of the investments coming from behind the meter. Thank you, John. Scarlett asked, when do you assume DER management reaches 100%? So for the purposes of this modeling, we assumed it was available from the beginning, but that doesn't mean it's all that useful from the beginning. The DER does reduce fuel while solar PV is on, but in terms of having an impact on avoiding new generation investment or new network investment, there has to be enough of it before that's able to be accomplished. So even though we've assumed an unrealistic 100% of DER is enrolled in a virtual power plant, it doesn't necessarily impact early years either way. People are welcome to ask follow-ups, by the way. John, does the scenario analysis include adoption of EVs with vehicle-to-grid bidirectional flow, which would bring large batteries behind the meter and could happen very fast as EV adoption goes ballistic? Look, I share your view that the electric vehicles have by far the largest battery, and having an 85 or 65 to 85 kilowatt hour battery in everybody's garage, or 2 of them, is going to dwarf what is currently seen as behind the meter. And so we did not model vehicle to grid. So the EV management within this modeling and was only load management. So you could reduce charging up to the amount of the charger capacity, but you were not going to have power go the other way. And so that's the limitation of the modeling as it stands. Newer versions of our models do have vehicle to grid in them, and it's a key modeling challenge for anybody who's in the game. I think the other thing to highlight, though, is that we didn't actually see the need for very large batteries behind the meter to have an impact. And from memory, 4 kilowatt hours growing over time was what I recall. So we could have a lot more behind the meter, but the key to the efficient deployment of distributed energy resources is to not get too far ahead of the game, or you've put out capital that is underutilized. Ton, okay, it appears that every analysis focuses on distribution network as the limits. Have you considered the transmission system limitations, such as minimum demand, where forecast supply is well over demand? So we looked mostly at curtailment and minimum runs of generation as the primary constraint in the transmission system. I fully acknowledge the issue of minimum demand, and have been talking to companies like Electronet in South Australia, and the challenges being faced there with supporting almost no, or in some cases no, native demand for periods of time. We didn't look at it in this study, and because of the complexity of the transmission system, it really requires load flow modeling, which is not something we typically do. We typically partner on that, but we do the production cost modeling, and with all the moving parts in this particular exercise, getting our heads around curtailment and how the system needs to be reconfigured over time while still maintaining security of supply and reliability was a major challenge. But in future, and in other work we do when we're actually modeling this transition for transmission companies, for vertical utilities, you've got to model the generation, the transmission, and the distribution all together, as well as behind the meter. So, Caitlin, your question, just to clarify, when you say customer, is that only DER owners or all customers? Look, that's a really important clarification because the NEO speaks to all customers and not just those with or without DER. And so in our modeling, and when we speak, and I sometimes get tripped up between customers and consumers, it is speaking to all consumers in terms of the net benefits. So those numbers we put out there in terms of costs and benefits, those are the deltas between the whole of system costs for producing electricity over the period to 2050, and the change, the difference in how much everyone's going to pay is what we've captured there.
We have a couple more that came in, Ezra, at the top of the questions.
Thank you. Okay. Just trying to get to them. Can we access the slide pack? Yes, so there'll be a follow-up email thanking you for your attendance and having a link to the material. And we welcome any further thoughts or comments once you've had time to sort of sit with the material. I realized that there was a lot to absorb in a short period of time. So Tan has a follow-up here relating to John Sibley's question above. Does the analysis include the total energy cost to consumers under different scenarios? And the answer is yes. So as I tried to communicate in the cost benefit sort of slide, the way that we come up with the total cost of service, it's all of the generation, operating costs and investment costs. It's all the network costs for CapEx and OpEx, and it's all the consumer costs for distributed energy resources. That's the sum total of what we're comparing in the scenarios. All right, Richard, who would be the main client user of this tool? So that's a very good question. So in terms of the modeling, folks that have an interest in the whole of system outcomes, so this is policymakers, regulators, are often those folks that engage us for this sort of modeling. Also industry associations that are looking for more support for their position. So we use this model to support the Electricity Network Transformation Roadmap, which ENA and CSIRO commissioned. And we also used it for the Smart Grid, Smart City project. It has insights and implications for anyone that wants to develop distributed energy resources, because it can help identify what areas are more likely to be constrained at its own sub-basis with public domain information. For distribution businesses who are also our clients, it helps them undertake integrated, optimized distribution resource planning, which is increasingly what we're seeing in the US as well. And it also is used by transport planners. So because it's whole of system, we've used it to look at electrification and decarbonization, as well as transport electrification, distribution planning, system planning, you name it. Okay, so John raises the question of dynamic operating envelopes, and that's a really important and timely question. So at the moment, we assume folks can connect, I think, up to about 8 kilowatts of solar on their system, and then we look at different levels of penetration on the asset to figure out if there's hosting capacity constraints. And we generally set those based on static and current conditions. Now, in other work we're doing on Project Edge, we're going to be improving our adherence to dynamic operating envelope outcomes, which I'm very much looking forward to doing, because it's going to allow us to show under static conditions how optimization, how optimal we can get the system compared to where we have dynamic operating envelopes. But in this particular run, it was more static. Are there any regulatory changes you consider necessary for a high DER scenario to progress? Oh, I really appreciate that question. So we lay out in the report what we think the key barriers and challenges are to realizing this potential future. And most of them are institutional, and some of them policy and regulatory action could certainly help. And I think top of that list is really incentives. And so in the next email that we're going to send out and have a webinar, and we're going to dive into the current incentives. And as an economist, I do have a belief that if you get the incentives right, the institutions and the organizations will respond accordingly. And so getting the incentives right is really important. It's great that the AER is undertaking their incentives review, and if we straighten those out so that the businesses involved can make more money by implementing the most efficient solution rather than adding to the regulatory base, where multipliers lead to, our estimate is about a 200% increase in shareholder value. We think that that's going to be a win-win-win for everyone. Will the recording of the session be available? I believe the answer is yes. Oh, Victor's answered that. Shandi, does the modeling look at EV battery supply? The behind the customer loads say household as part of the load control and peak demand scenario. So the model does analyze the load profile that the EV driver would be using, and whether or not it's a time of use or a flat tariff. And it also looks at the interplay between the EV tariff and other load, as well as PV and batteries. It then looks at the opportunity for changing the schedule of that charging whenever there is a network or a generation constraint. Paul, at present, small-scale storage is twice the cost of large-scale storage. Do you assume some convergence in cost over time or otherwise, and how does using small-scale storage result in lower system costs? Look, that's rooftop solar PV, right? Rooftop solar PV was much. But I don't know if anybody can hear me. So I was just saying, for Paul's question, rooftop PV was a higher cost, and it's now lower cost, and that's been acknowledged in AMO's ISP generation cost inputs. This is the first time also in the latest ISP that more behind the meter storage is part of the step change forecast than has been the case in the past. And yes, you're going to get economies of scale from storage as you have in solar. And it's really only the key economic thing to consider is, can behind the meter storage or any other resource be used for things that utility scale can't be? And I would point, to the extent that it's able to provide grid services in the distribution, HV, LV, and subtransmission network, those costs can come off of the cost relative to a utility scale solution. So that's one of the things I think the industry is going to have to get its head around, how to, first of all, open up these other areas for potential services, and then to consider the offset of those costs when comparing the cost of a utility scale versus behind the meter. All right, well, I'm not going to test my luck on connectivity. So with that, I think I'm going to wrap up the session for today. Thank you all for joining us. I hope that was interesting, and I look forward to the next one and receiving any feedback or comments in the meanwhile. Thank you very much.